The economy expanded at a slower pace in the second quarter as high consumer prices and interest rate hikes dampened growth. The country's GDP grew by 4.3%, and that's much lower than the 6.4% from January to March. And the average forecast of economists, excluding its contraction at the height of the COVID-19 pandemic, the economy last grew by around 4% in 2011. Despite El Nino and other possible threats to the economy, officials remain confident of the country's growth prospects.
This is a quite short-term phenomena that we can address, and we expect to see these remedial measures coming in and impact on the third and fourth quarters. The target is still achievable.
Let's now get the thoughts of John Paolo Rivera of Oikonomia Advisory and Research. John Paolo, thank you so much for joining us.
Hi, good evening.
Do you believe Mr. Balisacan saying that this is just a short-term phenomena?
Well, while Mr. Balisacan's claim could be accepted, work has to be done. If he's claiming that the growth rate targets can still be achieved, work has to be done, particularly in the field of agriculture, because we really have to fix our supply chain, our food prices, so that it dampens inflation and consumption can get steam again.
But what we're looking at right now, this drop from 6.4 to 4.3% is a lagging indicator. And we already are in the midst of the third quarter in the month of August. And John Paolo, we experienced Egay, Falcon, and we're seeing supply side pressures. We could see lower numbers than 4.3% in the third quarter from July to September.
Well, at the rate that we're going, a downward trend is expected, especially that the effects of the natural calamities are setting in, and the rate hike is continuing to weigh in on our growth rate. In fact, the second quarter growth rate is actually fueled by the lag effect of the rate hikes the BSP has implemented in the previous years and the slowdown in revenge spending of our consumers. And it just so happened that the second quarter of 2023, the growth is based from the growth in the second quarter of 2022, which is the election period where spending is so much during that time. And now we're suffering from that base effect from a high consumption spending in the previous year compared to today.
And we were talking about this in the exchange, wherein we still saw a lot of leisure spending, revenge and relief spending in the first and second quarter of this year. But it seems like we're already seeing the crumbs of this revenge spending.
Well, the fact that revenge spending happened in the first half of the year, it means that savings were not really given priority during that year, which is again weighing down on our economy right now because we're not able to have some capital accumulation because of too much spending during the first half of the year.
And if you take a look at what's really happening right now externally, Thailand, Vietnam, rice-producing nations are raising prices per ton. And then India also holding back on supply. Plus, all these typhoons hitting the agricultural sector. What is your outlook for the second half of the year, given that Secretary Balisacan is saying that we could achieve 6 to 7% growth with an average of 6.6% growth in the second half by attaining all of these goals?
Well, government would need to look for alternative sources of growth, particularly in terms of our OFW remittances that fuels consumption of our OFW-dependent households. Government can also build more on its project of infrastructure, to build better, more programs, to boost more spending in terms of infrastructure. And of course, we're still waiting for the benefits of the international travels of government in attracting foreign investments to come in. If that will materialize in the second half of the year, then the targets might be possible.
Yes, OFWs, they indeed produce month on month. They are really our heroes. But what about this build better more? I mean, it's not short term when you build a bridge or extend roads or highways. And international travels of the president, we have only seen a minuscule return so far in terms of those pledges.
That's why the goal now is for these to materialize, improving our branding or the imagery of the Philippines to the international market so that investors can come in, tourists can also come in, foreign tourists, and with that, spending can accumulate again in the country And with the upcoming holidays, we're expecting that consumption would be triggered again, which would contribute to unexpected growth.
But
again, it's not guaranteed.
There's really nothing that's guaranteed because 2 points that you mentioned are more to medium to long term, 2024 and beyond. What about cutting interest rates? Because that has really put a lot of pressure on the economy this year.
Well, the thing about our BSP governor is that he's basing decision on data. And according to the BSP governor, he will only cut rates if inflation would reach below 4%. And at the rate that we're going, inflation is not yet close to a healthy level of 4%.
Well, it's currently 4.7%.
Yeah?
Yeah?
But then it's still quite far, so we might not yet see a rate cut. But personally, I'm expecting a rate pause.
A rate pause because the next monetary board meeting of the Bangko Sentral ng Pilipinas is on August 17th. And we interviewed him last week. And he said, with all of this data, we could potentially even see not only a pause, but a rate hike, which could really clip the growth of the Philippine economy.
But it would be a tricky balance for the BSP because they're now balancing inflation with the performance of the GDP of our country. And implementing a rate hike might compromise the growth track that we're trying to achieve by the end of 2023.
All right. You have all of these risks, and you also have to add to the number of factors, El Nino and the volatile external trade conditions. I mean, these are definitely risks to growth in the second half of the year.
So that's why, given this risk, government would have to spend on investments in improving agriculture. It may be in the long term, but the spending on investment in improving agriculture at this point in time might do help in the second half.
But I mean, from July, I mean, if you just take a look at the short term, from July until December, 6.6% on average, John Paolo. Can that be achieved? Just like what Secretary Balisacan said for Oikonomia Advisory and Research.
Well, it's a long shot, but optimism can still kick in. There are other factors that we can rely on, particularly our OFWs, and who knows? It might happen. And given that calamities might not be here, there might not be any calamities for the second half of the year, it would be a great help.
But if you're pushing the numbers, calculating the data, John Paolo, what is your outlook for the second half of the year in terms of GDP growth, in terms of inflation?
Well, given the data that we have right now, inflation is expected to slow down, still to slow down. But then because of the impact of the rates, of the interest rates that we have right now, it has to counterbalance with each other, affecting our GDP growth. And it's very slim. There's a very slim chance that the targets can be met, though I'm not saying that it is impossible, but a lot of work has to be done.
Yes, a lot of work indeed has to be done. External conditions as well impacting the Philippine economy. You still have, of course, the U.S. Central Bank raising the cost of borrowing by another quarter of a point. And potentially, we could see a recession in the United States taking place.
But the exposure of the Philippines is quite lower this time, given that we're now pivoting towards other trading partners aside from the United States.
All right. Thank you so much for your insights on the Philippine economy. John Paolo Rivera from Oikonomia Advisory and Research.
Thank you.